Welcome back to our channel. In today's video, we are diving into a topic that often leaves taxpayers puzzled: income from house property under the Indian Income Tax Act. Whether you are a homeowner, an investor, or simply curious about how the tax system works, this video is for you. By the end of this video, you will have a clear understanding of what constitutes income from house property, how it's calculated, and the key exemptions and deductions available to you. But before we dive into the details, don't forget to hit that subscribe button and ring the notification bell so you never miss out on our latest content. Now, let's get started. What is income from house property? Income from house property is one of the 5 heads of income under the Indian Income Tax Act. It refers to the income earned from letting out the property, whether residential or commercial. This income is taxable under the head, Income from House Property. The important thing to note is that this income is taxable even if the property is not actually rented out. If you own more than one property, the other properties, other than the one you reside in, are considered to be let out, and their income is deemed for tax purposes. Conditions for taxability. To qualify as income from house property, 3 conditions must be met. 1. The property should consist of buildings or land appurtenant thereto. 2. The taxpayer must be the owner of the property. 3. The property must not be used by the owner for the purposes of any business or profession carried out by them, which is the income of which is chargeable to income tax. If all these conditions are satisfied, the income from the property will be taxed under this head. Understanding gross annual value, GAV. The first step in calculating income from house property is determining the gross annual value, GAV, of the property. GAV is the higher of 1. Rent received or receivable. 2. Expected rent, which is based on the municipal valuation, fair rent, or standard rent as per the Rent Control Act. However, if the property is self-occupied or cannot be let out due to being in a location that's difficult to rent, the GAV is considered to be 0. Deductions from gross annual value. Once the GAV is determined, the next step is to deduct the municipal taxes paid during the year. Municipal taxes are deductible only if they are paid by the owner and during the financial year. After deducting municipal taxes from the GAV, what you get is the net annual value, NAV. Standard deduction and interest on home loan. The Income Tax Act allows 2 main deductions from the net annual value. Standard deduction. A flat 30% of the net annual value is allowed as a deduction. This deduction covers repair and maintenance costs of the property, irrespective of the actual amount spent. Interest on home loan. If you've taken a loan to purchase, construct, or repair the property, the interest paid on such loan is deductible. For a self-occupied property, the maximum deduction allowed is 2 lakh rupees per annum, provided the construction or acquisition is completed within 5 years from the end of the financial year in which the loan was taken. If the property is rented out, there is no limit on the interest deduction. Calculating taxable income from house property. Let's quickly recap the steps to calculate the taxable income from house property. 1. Start with the gross annual value, GAV. 2. Deduct municipal taxes to arrive at the net annual value, NAV. 3. Apply the standard deduction of 30% on the NAV. 4. Deduct interest on the home loan. The resulting amount is the taxable income under the head, Income from House Property. Special cases and exemptions. Before we wrap up, let's touch on a few special cases and exemptions. Vacancy allowance. If your property is vacant for part of the year and the actual rent received is less than the expected rent, you can claim a deduction for the vacancy period. Company ownership. If the property is co-owned, the income from the property is divided among the co-owners in proportion to their ownership, and each co-owner is taxed separately on their share. Deemed ownership. In certain cases, like when you transfer a property to your spouse or minor child without adequate consideration, you are still considered the deemed owner and are liable to pay tax on the income. Conclusion. And there you have it. That's a comprehensive overview of how income from house property is treated under the Indian Income Tax Act. Understanding these concepts can help you better manage your finances and avoid any tax surprises. If you found this video helpful, make sure to give it a thumbs up and share it with others who might benefit from this information. And remember, if you have any questions or need further clarification, drop a comment below. We are always here to help. Thanks for watching, and see you in the next video.